Welcome to vTalkInsight, Allocator's Lens Daily for January 29th, 2026. Powerful AI-driven growth, a softer dollar, and surging gold are reshaping the balance of risks across equities, bonds, currencies, and commodities, so cross-asset linkages matter more than ever today. In equities, the starting point is still a broadly supportive, risk-on backdrop for global markets. Most United States sectors are in positive territory for the year, and almost every major country index is trading above short-term trend measures, pointing to a synchronized upswing rather than a narrow rally. Small caps and cyclical areas have been outperforming, helped by fiscal support and improving unemployment data, while resource-heavy sectors such as energy and materials are benefiting from stronger commodity prices and a softer dollar. The S&P 500 has been consolidating near record highs, with recent daily moves modest and implied volatility sitting in the mid-teens, consistent with investors remaining comfortable with the growth narrative even as they quietly pay more for downside protection. Beneath the surface, the equity story is increasingly anchored in AI-driven earnings and capital spending. Productivity gains from AI are being cited as a key driver of United States GDP, offsetting subdued payroll growth and reducing the economy's dependence on rate-sensitive sectors. That same theme is visible in markets, where semiconductor and infrastructure names continue to deliver standout results. Companies such as ASML, Texas Instruments, Seagate, and SK Hynix have reported strong quarters, record bookings, and upbeat capital expenditure plans linked to AI hardware, with high-bandwidth memory and advanced lithography in particular seen as tight through at least 2027. At the index level, the valuation premium for technology over the broader market has narrowed meaningfully from last year's extremes, while earnings trends remain robust, which lowers the bar for positive surprises even though absolute multiples are still elevated. At the same time, several signals warn that the equity advance is becoming more fragile. The top cluster of large technology-related stocks now represents roughly 2/5 of the S&P 500 by market value, making overall index direction heavily dependent on a small group of names and their AI investment plans. Recent gains to new highs have been driven by this narrow leadership even as breadth has deteriorated and volatility has ticked higher, with one measure up more than 4.5%, suggesting rising demand for hedges. Retail investors have also increased leverage, with margin borrowing relative to available credit at multi-decade highs, while consumer confidence is near decade lows and concerns about hidden labor market weakness are growing, creating a tension between buoyant asset prices and a more cautious household sector. For allocators, that mix of AI-powered growth and concentration risk puts equities at the center of the macro story. If productivity gains keep inflation expectations anchored and the Federal Reserve ultimately validates current projections for 2 to 3 rate cuts, high multiples could be sustained, particularly for cash-generative technology and quality cyclicals that benefit from fiscal, spending, and a weaker dollar. In a less friendly scenario, a rapid dollar decline that pushes up imported inflation or renewed tariff shocks feeding through to goods prices could force long-term yields higher and pressure valuations, especially in the most richly priced parts of the market. Equity investors will therefore be watching upcoming mega-cap tech earnings, AI capital expenditure guidance, and labor market data closely because they now function as both micro drivers of sector performance and macro signposts for the broader cycle. Turning to rates, the dominant picture is one of strong growth colliding with a patient, data-dependent Federal Reserve. Near-term United States activity trackers point to annualized growth above 5%, a pace not seen in years, while consensus forecasts are still anchored closer to 2% per quarter, leaving clear upside risk if AI-related investment and fiscal spending keep surprising. Inflation expectations in markets and surveys have eased back toward levels consistent with the Fed's 2% goal, yet core personal consumption expenditures inflation has stalled around 3%, and tariff-related goods prices are still working their way through the system. Against that backdrop, markets are no longer pricing cuts in the first half of the year, with most expectations clustered in the second half. even though some forecasters still see a path to earlier and possibly deeper easing if disinflation resumes. At the long end of the curve, yields remain notably higher than in the pre-pandemic era, reflecting both stronger productivity, growth expectations, and persistent fiscal concerns. The 10-year Treasury has been confined to a narrow range around 4 to 4.35% since the last hike, and the 30-year bond has traded near 5%, indicating elevated term premia and structurally higher real rates. Even so, demand for duration is robust. Foreign holdings of treasuries are at record highs, auction results have been solid, and investors have been rotating from credit into longer-dated government bonds as rising term premia and positive carry make that part of the curve more compelling as a portfolio ballast. Fed balance sheet operations, including roughly $40 billion per month in liquidity injections, and relatively stable coupon issuance at the long end, are also helping keep the curve contained despite political noise and leadership uncertainty. Looking ahead, the key question is whether the balance of risks tilts toward lower or higher yields from here. On one side, several indicators suggest inflation risks are skewed to the downside over the coming year, with housing and rent trends expected to keep headline measures contained and some market-based pricing pointing to consumer inflation potentially dipping below 2%, which would create space for more rate cuts than are currently priced. On the other, persistent wage growth, deglobalization, immigration limits, and a weaker dollar all pose upside risks to inflation and could drive a bear steepening if the Fed is seen as too slow to respond, especially if Treasury issuance patterns change or foreign investors demand higher compensation for currency risk. Against this backdrop, wage data, upcoming labor reports, the quarterly refunding announcement, and any developments around the Fed chair nomination process are likely to be the main catalyst for the next significant move in the curve. In credit, surface-level conditions remain benign, even as underlying stresses are becoming more visible. Financial conditions are easy, with tight spreads, near-record corporate profits, and a softer dollar all supporting demand for both United States and emerging market issuers. Despite political concerns and debate about United States policy credibility, foreign appetite for treasuries and corporate bonds has stayed firm, underscoring the depth and perceived safety of dollar credit markets. At the same time, AI-related companies are becoming a larger slice of investment-grade indices and private markets, reflecting a structural shift in capital allocation that channels more funding to technology infrastructure and away from more traditional, rate-sensitive borrowers. Beneath that strength, however, there are growing signs of pressure on the consumer that matter for credit risk. Several years of compounded inflation have eroded purchasing power, leaving many households feeling that day-to-day prices are increasingly unaffordable, even though aggregate labor market data still looks solid. Part-time employment is at record highs and multiple job holding is not rising, suggesting that headline unemployment may be overstating the true resilience of the labor market, while lower-income consumers are trading down and cutting discretionary spending. Policy proposals to cap credit card interest rates could also tighten credit availability unintentionally, increasing default risk in unsecured lending segments precisely as household balance sheets are being squeezed. For multi-asset allocators, that creates a nuanced credit picture. Investment-grade and higher-quality issuers still benefit from healthy profits, global demand for yield, and the AI investment cycle. But segments exposed to weaker consumers, rising tariffs, or regulatory shifts could see a more challenging environment. At the same time, rising term premia have encouraged some investors to move out the government curve for defensive carry, which can reduce marginal support for spread products, especially if volatility picks up in rates or foreign exchange. Default data, bank lending standards, and performance dispersion between corporate sectors are likely to be key indicators of whether today's tight spreads remain stable or start to widen from here. Foreign exchange markets are increasingly central to expressing macro views as the dollar drifts lower and volatility rises. United States officials have shown a growing tolerance for a weaker dollar, and recent political comments have fueled expectations of a more prolonged decline, which is being reflected in higher costs to position against the dollar in options markets. So far, the move has been relatively orderly and has not triggered destabilizing capital flows, but history suggests that the pace of depreciation, rather than the level, is what tends to generate stress in global funding markets. For corporates and investors, higher hedging costs and greater two-way volatility are already making currency management a more active decision rather than a background consideration. Across major currencies, policy divergence and political risk are creating a patchwork of idiosyncratic stories rather than a simple dollar down, rest up regime. The euro has strengthened at times, even briefly touching 1.2 against the dollar on United States political headlines. But the European Central Bank is concerned that a persistently strong currency could push inflation below target and may consider further easing if appreciation endures. The yen remains significantly undervalued on many measures, yet high public debt, domestic political uncertainty, and continued loose monetary policy in Japan are limiting its ability to appreciate, keeping investors cautious about relying on it as a straightforward safe haven. More broadly, major central banks are resisting sustained currency strength, which raises the risk of competitive devaluations and a slow-motion currency war as authorities juggle export competitiveness, inflation control, and financial stability. These currency dynamics have important feedback loops into rates and risk assets. A gradually weaker dollar supports United States exporters and commodity prices, and it has contributed to the outperformance of resource-heavy equity sectors and emerging issuers that borrow in dollars. However, a sharp dollar decline could import inflation back into the United States, push intermediate and long-term yields higher, and undermine the case for aggressive Fed easing, while also upsetting foreign holders of treasuries who may demand higher compensation for currency risk. Given mounting geopolitical tensions, shifting trade relationships, and talk of de-dollarization, the pace and drivers of dollar moves are likely to be as important for allocators as the level itself. Commodities, and gold in particular, are where many of today's macro tensions are most visible. Gold has gained strong momentum and is trading near record highs, supported by a weaker dollar, persistent geopolitical risks, and increasing allocations from institutional investors and non-OECD central banks looking to hedge against market and currency uncertainty. The metal's market size is small relative to global financial assets, so even modest reallocations out of equities or bonds can move prices significantly, a dynamic amplified by new entrants such as a major crypto firm that has accumulated around 140 tons of physical gold and continues to add. At the same time, some investors are linking gold demand to expected manufacturing and infrastructure build-outs related to AI, blending traditional safe haven motivations with a more growth-oriented narrative. From a risk management perspective, gold now looks both structurally supported and tactically stretched. Prices sit roughly 2 standard deviations above their 20-year trend, and some high-profile forecasts have floated levels as high as $7,000 by year-end, highlighting how enthusiastic parts of the market have become. Heavy inflows from new institutional buyers have increased liquidity, but also raised the potential for sharp pullbacks if geopolitical conditions improve or if the dollar stabilizes, and volatility has picked up as macro hedging flows interact with more speculative positioning. A further extension toward 3 standard deviations above trend would historically be associated with significant financial stress. So gold's behavior around major policy and geopolitical events is an important barometer of how nervous investors really are. Silver and the broader commodity complex round out the picture. Silver has rallied even faster than gold, compressing the gold-silver ratio to unusually low levels and suggesting that parts of the precious metal space may be vulnerable to mean reversion if risk appetite fades. Industrial commodities are being supported by expectations of ongoing AI and energy infrastructure investment, which is relatively insensitive to interest rate changes and underpins the outperformance of energy and materials equities. For multi-asset portfolios, the key question is whether today's strength in metals and resource-related assets is mainly a reflection of durable demand from electrification and AI, or whether it is increasingly a mirror of currency and policy anxiety that could unwind if the macro narrative stabilizes. Stepping back, the cross-asset picture combines strong, AI-driven United States growth and easy financial conditions with higher for longer real yields, a softening dollar, and powerful moves in gold and other commodities. Equities remain supported by earnings and fiscal tailwinds, but leadership is narrow and leverage and sentiment divergences are building. Rates markets are wrestling with whether disinflation or sticky inflation and currency pressures will dominate, while credit still enjoys tight spreads even as consumer stress inches higher. In foreign exchange, the key risk is not simply a weaker dollar, but the speed and policy backdrop of that move, given rising currency war rhetoric. Commodities, especially gold and silver, are both beneficiaries of AI-related demand and signals of potential macro unease. Allocators may want to watch how upcoming labor data, central bank communication, and currency moves feed through jointly into yields, equity leadership, and commodity pricing, as that interaction is likely to shape the next leg of this late cycle environment. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.